Um, I said the AIA extension was one of the very few bits of good news. In terms of us spending a lot of time dealing with owner-managed businesses, the announcement of the reduction in R&D credit certainly was not welcome. So with effect from 1st of April 2023, the rate at which R&D expenditure is relieved for CT purposes is reduced. So whereas in the run-up into 31st March 2023, for £100 of expenditure, a company could claim a deduction of £230. With effect from 1st of April, that £100 expenditure will only secure an 86% super deduction. So it will be a £186 deduction for corporation tax purposes. Now, to an extent, that is offset because of the raise in corporation tax rates. You know, if you are a company that is paying 25% corporation tax, the 86% super deduction perhaps actually gives you a little bit more for your money, but it certainly is not welcome at all that the rate has been reduced, the rate of super deduction has been reduced. More importantly, the government has made it clear that they are moving towards a single R&D scheme for entities both small and medium size and large. They've made the point that no other government apparently operates a different scheme for small and medium sized enterprise from the general way that their R&D works. Now, what we need to bear in mind for small and medium-sized enterprise is the scheme has to be workable, and it doesn't have to be overly burdensome from an administration viewpoint, and that's a concern with regards to the direction of travel. Also, what is worrying is the attitude that HM Revenue and Customs have taken to particularly small and medium-sized enterprises and R&D tax credit claims. They have gone since the introduction of R&D. They've been flip-flopping all over the place. Really quite a febrile approach. So they go from an attitude of welcoming claims to being very resistant to claims. And you know, there's been a great deal of criticism that R&D has been used inappropriately by some small and medium-sized enterprises and their advisors. The knee-jerk reaction that there has been to that over recent years has been a very, very aggressive response from HM Revenue and Customs to even the most generous of claims. You know, we're seeing cases where claims which we view as very, very strong are getting wholly inappropriate responses from HM Revenue and Customs, and you know, there are complaint cases being taken, etc. So if you are involved with R&D, making R&D claims in respect of your company, be aware that it is probably a more drawn out process than it has been in previous years. And do remember that there is a fundamental requirement that there must be scientific or technical uncertainty to what you're doing, and understanding and driving down to what that issue is absolutely fundamental. The team we've got involve people with software and scientific backgrounds and what have you. So, you know, we do expect to look in a great deal of detail as to what the project is, what the issues are, etc. So moving on, as I mentioned at the outset, you know, we are in a situation where base rates have gone up to 4%. We've heard credible speculation of the base rates going up to 4.25%. And we need to understand that having been in a low interest rate environment for the last decade or so, well, more than a decade, the tax system has settled itself into that environment. And increased interest rates will, without doubt, create some painful situations for certain sectors. The revenue have set, I think since time immemorial, interest for late paid tax at base plus 2.5%. Now, one particular area that care will need to be taken on is, say, for example, companies that do pay under the quarterly instalment regime. Because if you get your payments wrong and underpay, and sometimes it's very difficult to accurately project what your quarterly instalments should be because they're based on current year profitability, interest on overdue tax is going to be painful. Another corporate related issue for larger companies is there's a complex restriction on loan interest relief and associated costs for companies, where the floor is set at £2 million, i.e. you don't have to consider corporate interest relief, corporate interest restriction until you've hit an interest cost of £2 million. So as rates increase, more companies are going to be sucked into this provision. And as I say, the rules are potentially very complex. One has to be prepared for the consequences of finding oneself within CIR. Another area where there will be collateral damage is that for buy-to-let owners. So if you are a landlord who owns residential property in your own name, basically loan interest relief was restricted by George Osborne in his last budget to a 20% credit rather than a full deduction against rental income. So what that means in practice, as set out in the slide, say for example you pay £15,000 interest per annum and you're a 45% taxpayer, that is your income in total is over £150,000. Basically you will end up paying tax on the interest that you pay. So £15,000 of interest, basically you will pay £3,750 of tax on the rent, even though it has been consumed wholly by interest that you pay. It's worth saying corporate buy-to-let owners are not impacted by these rules. So that is one of the reasons why we've seen over recent years a shift from personal to corporate ownership of buy-to-lets. It's quite involved to get there, and the facts have to be right because of the capital gains tax and SDLT consequences of incorporation. But sometimes it is possible, and as I say, it has been quite prevalent over recent years. Moving on, the dividend allowance was introduced at the figure of £5,000 back in 2016. There was a change to dividend taxation at that stage. That was subsequently reduced to £2,000 in 2018. It's now been reduced to £1,000 from April 2023 and £500 from 2024. This represents a substantial increase in the effective rate of tax on dividend income, as I set out on the slide. If you look at a top rate taxpayer, up until April 2016, the effective rate was 30.6%. I think it was actually 30.55, but I've rounded it up. With effect from April 2016, that's gone up to 38.1%. And then with the tax rises introduced with effect from April 2021, the rate's gone up to 39.35%. So dividend taxation was increased at the same time as national insurance was increased. And whilst the national insurance rates have been reduced back to where they were, dividend taxation has stuck. Now, it does mean that we're in the situation that in certain situations, post April 2023, because of the increase in corporation tax, dividend taxation may be a more expensive way of getting money out of a company than taking money by way of salary. And you'll see from the slide that taking money out of a company by way of dividend or salary is significantly more expensive than operating on a self-employed basis. So it's one of those situations where we have to look at the comparative advantages and disadvantages of company versus self-employment. If you are looking at companies, if you have loans to companies, or say, for example, you own the premises from which the company trades, taking money out by way of an interest charge on your loan to the company or rental income from the property that you own could be quite an effective way of taking money out, because that will take the marginal rate down to the basic rate of tax that you are paying. So 20% for basic rate payers, 40% for higher rate payers, and 45% for the additional rate. So comparatively cheaper than either dividend or salary. One thing that sometimes is possible to do is use relationships between grandparents and their grandchildren to help the family as a whole. So the position is that income that arises to children will be taxed generally at their rate of tax. So you are born with a personal tax allowance, you're born with a basic rate band. Now, the one thing that you can't do until your children reach age 18 as a parent is try and exploit those bands by placing assets in your children's name. You will remain taxable on the income, and capital gains could arise in respect of transferring assets to them, etc. It's basically a no-go area. But if we're in the situation where grandparents have reasonably modest amounts of money, and let's say, for example, they're prepared to gift money to their grandchildren, that can become quite attractive, particularly where that money is used to fund, let's say, shares in a private company, etc. The facts have to be right, and you have to make sure that you behave reasonably and commercially from a valuation viewpoint. But certainly, grandparental settlements have great attraction to them. We are in the run-up to the most substantial change in the taxation of self-employed people. So the true self-employed partners and members of LLPs in a long time. So that is going to impact from April 2023, and I'll go through what it means. So since the mid-late 1990s, we have operated what's called the current year basis. So that means that a business pays tax, or a taxpayer pays tax on his business profits based upon the accounts that end in the tax year. So as set out on the slide, 31st December 2021 would form the basis of a 2021-22 tax year profit. 31st May 2022 would be taxed in 2022-23. There have always had to be special rules to deal with commencement where there's been double taxation, particularly where the accounts year is anything other than 31st of March. That creates what's called overlap profits that are then, so the double taxed profits when you start are relieved when you cease. From 2024-25, we will be moving on to what's termed the actual basis. So you're looking at apportioning your profits so that, as set out, for the year to 5th April 25, if you've got a 31st December year end, you would take 9/12 of the profits for 31st December 2024 and 3/12 for the year to 31st December 2025. Now, as I set out on the slide, for the year to 5th April 2025, the filing deadline will be 31st January 2026. And of course, it's highly unlikely that the December 2025 figures will be available when you have to file your tax return. That means that provisional returns will have to be filed, and it will be a case then of correcting those returns as and when in this instance, December 2025 figures are available. That's all about accelerating tax. The government finances operate on a cash basis. So accelerating tax is good from a viewpoint of massaging their figures. It's by no means a simplification, and it's going to be quite a pain to deal with. Because of that change in rules, there has to be a transitional period. And that's going to be for the year to 5th April 2024, the tax year starting in a couple of months' time. So what profits will be assessed for 2023-24? Again, keeping to the 31st December year-end example, you will first tax the profits that will be taxed in any case under the current year basis. So in this example, 31st December 2023. You'll add the time apportionment. I see on the slide it's TIM apportioned, but time apportioned profits. So in this instance, 31st December 2024, 3/12 of that, minus the overlap relief that is available. Now, the issue that you've got is quite often overlap relief is significantly lower than prevailing profits, basically because it was the double tax profits when you started. And obviously businesses, the hope is that profits increase over time. So overlap relief can sometimes be relatively modest. So that could well mean that you've got more profits that fall into the higher rates of tax because of the aggregation of these three factors. That will particularly impact on its suspected businesses with tax year ends that are early in the tax year, for example, 30th April and 31st of May. In order to try and mitigate against the impact of that, there is what's called a spreading charge. So you can elect for effectively the augmented profit to be spread over 5 years and taxed accordingly, which is reasonably welcome. But previous experience of spreading charges is that they do become a bit administratively burdensome. What that means is businesses should look at their profits assessable for the year to 5th April 2023 quite critically. Now, the knee-jerk may well be to move towards 31st March year end because it will make life simpler under the new basis. But it can be, depending upon your profit trends, that's not the case. So looking at trends in profitability when looking at your tax return for the year to 5th April 2023 may well be well worthwhile. It also is another juggling feature of looking at company versus self-employment, because essentially with the actual basis of paying tax on self-employed profits, you're paying tax more or less as you go along. Whereas, as I mentioned earlier, with small companies, you pay tax on your profits 9 months after the year end. You also can set when you are going to pay tax personally by reference to dividend, salary, etc. However, as I set out, the tax rates for companies are somewhat higher for dividend and salary extraction. So it's quite a complex analysis that turns really upon each person's position. Moving on, capital taxes. So we did have quite an extreme worry that capital gains tax could move to marginal rates of tax. I don't think it will happen, but that's famous last words. We have been in a position, though, where the £10 million entrepreneurs relief has reduced to £1 million of business assets disposal relief. So broadly, now on realising a capital gain on the sale of a business or shares in a trading company, the first £1 million from a lifetime viewpoint per individual can be taxed at 10%, and the balance is taxed at 20%. Now, there is a contrast between the way that individual profits are taxed and the way that company gains are taxed. So where a company holds shares in another company, basically more than 10% of the shares for at least a year, there's unlimited relief from corporation tax if that company sells the shares in its subsidiary. So zero gain, zero tax versus paying 10/20%. Substantial shareholdings exemption may well be a more attractive relief, but you need to be structured appropriately. And planning in time for a future exit is really important. I also make the point on the slide that substantial shareholdings exemption may be a more robust relief than business asset disposal relief. SSE was brought in basically as part of competitiveness of the UK corporation tax system as compared to other jurisdictions. So it is part and parcel of trying to make the UK attractive from a corporate tax viewpoint that SSE is there. Now, of course, there have been quite a lot of press coverage about the impact of the 25% corporation tax rate on the UK from a global corporate competition viewpoint. But I think SSE is there for the long term. It's also worth just commenting on inheritance tax. Again, the Office of Tax Simplification, before its abolition, reported on reforms to IHT. We've now had the nil rate band fixed at £325,000 for over a decade. There's the relatively restrictive residence nil rate band of £175,000. That tends not to be particularly useful for business owners, because even where business property relief is in place, you look at the value of estates before BPR. Inheritance tax is a minnow from an economic viewpoint in terms of the tax that it's raising. However, the impact of the frozen nil rate band is that it is raising significantly more money now than it used to be. And of course, it does impact disproportionately on those parts of the country with high property prices. So just looking to where we stand today, looking forward, as I say, budget 2023, we're not so far away from an election. It does seem that there are internal strains within the current government, or rather within the Conservative Party, with regards to tax cuts versus tax raises. The likelihood is that the budget coming up will be steady as she goes, and anything any fireworks, certainly of a positive side, will be in the 2024 budget. If we see significant changes introduced in November 2023, when the autumn statement is due, that may well be indicative of an early election. But with current opinion polls as they are, the suggestion is that the election will be put off to comparatively late in the permitted term for the current government. So, thank you very much, everyone. I hope this has been useful. It's very important that it is understood that tax is complex, and there is nothing that beats actually proper advice with regards to your own position. So this has tried to be an overview, and please don't place reliance on it in isolation. If you do want to get hold of me, details are on the screen. If not, get hold of your Gravita contact, and we'll do our best to help you out. In the meantime, thank you for listening. Again, my name has been Nigel May, and thank you for your time. Goodbye.